John Deere has just rocked the U.S. farming industry with a move no one saw coming. Massive discounts on some of its most in-demand machinery. For decades, Deere's pricing strategy has leaned on premium quality, premium cost. But now, that's out the window. The company just slashed prices across tractors, combines, and precision ag equipment, signaling a complete shift in its strategy. This isn't a seasonal promo or a trade-in event. This is a calculated industry-disrupting pivot, and farmers across the country are scrambling to get in on it. Why now? That's the billion-dollar question. John Deere isn't doing this out of kindness. It's responding to pressure. With used equipment piling up at dealerships, interest rates still high, and low commodity prices squeezing farmer profits, demand for new machinery has been flatlining. Meanwhile, cheaper alternatives from brands like Mahindra, Kubota, and even Chinese upstarts are gaining traction fast. Deere's answer? Go on the offensive, slash prices, flood the market, protect its turf. And they didn't stop at just the base models. We're talking serious markdowns on high-tech models loaded with GPS, self-driving capabilities, and real-time data analytics. These machines, once out of reach for small and mid-sized farms, are now suddenly accessible. It's a game changer, and it's sparking a new wave of interest from farmers who had been holding off for years. Dealers from Iowa to Georgia are reporting a massive spike in foot traffic and quote requests, some even saying it's their busiest summer since 2013. But here's where things get really interesting. This isn't just about selling more machines. Deere knows it's at a crossroads. The rise of ag tech startups, the push for electrification, and global uncertainty around supply chains have created a perfect storm. Deere is slashing prices now to secure market dominance tomorrow. Lock in. Loyalty. Flood the fields with green and yellow before competitors can react. And farmers? They're calling it both a blessing and a shock, because for many of them, this is personal. John Deere isn't just a brand, it's practically part of their identity. But over the years, loyalty was starting to crack under the weight of rising costs, restrictive software locks, and repair restrictions. Now Deere's flipping the narrative. Lower prices, more access, and a renewed focus on putting power back into the hands of farmers. Whether this is a sincere shift or a clever business tactic, that's still up for debate. And while Deere's move is dominating headlines, it's also sending shockwaves through the entire ag machinery ecosystem. Competitors are now under pressure to match or risk being steamrolled. Analysts say we could be heading into a full-blown machinery price war, one that could reshape the entire farming equipment landscape. Smaller brands might not survive. New alliances might form. And Wall Street? It's watching Deere stalk like a hawk. But the biggest impact, no doubt, will be felt on the ground. By the farmers who can finally upgrade their equipment without mortgaging the future. And those farmers aren't staying quiet. Social media is lighting up with posts from across the Midwest. Photos of brand new 8R tractors, S-Series combines being delivered, and grain farmers openly celebrating the chance to modernize after years of tightening belts. Some are even calling it a mini farming renaissance, finally able to invest in efficiency without taking on crushing debt. From Ohio to Nebraska, the mood has shifted. Farmers who had all but given up on upgrading are suddenly calling their local Deere reps and locking in deals. But the shift isn't just financial, it's strategic. With newer, smarter equipment hitting the fields, farms are unlocking productivity levels they haven't seen in years. Machines are planting with centimeter-level precision, harvesting with real-time moisture sensors, and sending live diagnostics straight to the farmer's phone. And with Deere's discounts making this tech more accessible, small family farms, once left behind in the ag tech revolution, are now catching up fast. It's narrowing the digital divide in agriculture in a way we haven't seen before. Meanwhile, whispers are already circulating that this move might be the first step in a much larger transformation. Industry insiders say Deere could be gearing up to shift its entire business model, possibly leaning harder into subscription-based services and data platforms. Imagine this: sell the machines cheap, but monetize the software, analytics, and automation tools that power them. It's the classic razor and blades strategy, and Deere might be positioning itself to dominate both hardware and ag tech services. Of course, not everyone's cheering. Some farmers worry these price cuts are temporary, just a bait and switch tactic to undercut rivals before hiking prices again. Others fear the deeper integration of digital systems means even more lock-ins and less control over their own machines. The right to repair debate is far from over, and many in the ag community are cautious, even as they celebrate the discounts. But there's no denying it. Deere has just forced the entire ag industry to recalibrate. Dealerships are scrambling. To realign inventory, competitors are calling emergency strategy meetings, and investors are rushing to understand what this means long-term. It's more than just a price drop. It's a power move, and one that could define the future of farming in America for years to come. And now the ripple effects are spreading beyond traditional crops. Ranchers, orchard managers, and even specialty crop growers are suddenly re-evaluating their equipment plans. The knock-on effect is massive. From fertilizer suppliers to fuel vendors, everyone connected to the ag supply chain is watching closely. What Deere just triggered isn't a sale. It's a reset button on the entire U.S. farming economy. And those rival brands? They're scrambling. CNH Industrial, the parent company of Case IH and New Holland, is already rumored to be drafting emergency rebate programs to slow the bleeding. Dealerships that carry both brands are reportedly fielding calls from corporate HQ, demanding aggressive counteroffers and instant feedback from the ground. Some are even offering extra incentives, extended warranties, 0% financing, or free maintenance packages to keep buyers from jumping ship to Deere. But the truth is, Deere has already stolen the spotlight, and it's not just about the discounts, it's about dominance. Kubota, once seen as the go-to for small to mid-scale farms, is especially vulnerable. Their compact and utility tractors thrived in the gap left by Deere's high pricing. But now, that gap is disappearing fast. If Deere continues undercutting on both tech and price, Kubota could be forced to slash margins just to stay relevant. Something their current North American strategy isn't built for. AGCO, which owns Fendt and Massey Ferguson, is also under pressure. Their premium European-engineered machines have been climbing steadily in reputation, but now they're at risk of looking overpriced, even if they outperform on specs. And globally, the shockwaves are already reaching as far as Europe, South America, and Australia. Deere's aggressive U.S. discounts are prompting questions in international markets. Will similar price drops follow overseas? Or is this a U.S.-only battle? Plan to protect domestic turf? Dealers in Canada and Brazil are already fielding frustrated calls from farmers wondering why their neighbors to the south are getting machines at thousands less. If Deere's move goes global, it could rewrite the rules of agricultural equipment. Pricing worldwide. Back in the U.S., auction houses and used machinery sellers are feeling the squeeze. Prices for late-model used equipment are dropping fast, and dealers sitting on high-mileage trade-ins are starting to panic. Why would anyone pay nearly new prices for a 5-year-old model when fresh, warranted iron is being sold for just a fraction more? It's a ripple that's quickly turning into a wave, crashing through rural markets and forcing everyone, from bankers to insurance firms, to recalculate the value of equipment on the books. And while Deere's boardroom might be celebrating this aggressive play, make no mistake, this is high risk, high reward. If competitors manage to respond quickly, or if supply chain constraints choke off Deere's ability to deliver on these promises, the company could find itself overcommitted. But for now, they've seized control of the narrative, and every other manufacturer is reacting, not leading. Meanwhile, out in the fields, the real winners, for now, are the farmers. For the first time in years, they've got leverage. They can negotiate harder, demand better deals, and choose from a wider pool of advanced equipment without breaking their budgets. Some say it feels like the playing field is finally tilting back in their favor. But the question is, how long will it last? And now, Washington is paying attention. With rural economies heavily dependent on farm equipment cycles, Deere's aggressive pricing shift could ripple into federal ag policy discussions. Lawmakers are starting to ask, should subsidies, grants, and tax incentives adjust to reflect the new lower cost of machinery? Will this shift alter the structure of USDA equipment loan programs? And more critically, if Deere floods the market, What happens to small-town equipment dealers who rely on higher-margin used sales to survive? The pressure on rural credit unions and ag lenders is also building. Financing packages written just last year assumed equipment values that are now suddenly outdated. As Deere resets the baseline price of machinery, the collateral value on existing loans is falling. That's a potential time bomb for banks across the Midwest. Some are even quietly working on re-evaluating loan-to-value ratios to avoid a mini ag loan crisis.